What is cryptocurrency? Well, let's start with defining what Bitcoin is because it's by far the most popular form of cryptocurrency out there. It kind of started the whole thing, all right? The first legitimized cryptocurrency was Bitcoin. The U.S. financial markets seem to have taken to it. There are even mutual funds that are invested in cryptocurrency. You can't go anywhere without hearing people talking about making money in cryptocurrency. Well, there's nothing wrong with making money in cryptocurrency. However, there's lots of disinformation about there, both how to save taxes involving cryptocurrency and whether you need to report cryptocurrency at all. A lot of people believe that cryptocurrency transactions cannot be traced or verified, and that you're free to make money in cryptocurrency and not report it for tax purposes. I can tell you that the on-ramps and the off-ramps of cryptocurrency are very, very visible, okay? The on-ramps being where you move funds around to make the original investments that can be seen in an audit or criminal tax investigation, and where you pull money out of cryptocurrency. Also, the government has formed relationships with private companies to be able to know more about your cryptocurrency transactions than you might imagine. I mean, every single transaction involving cryptocurrency is out there on a public ledger. And if they could attach your identity to any part of that register, they can see every transaction you've transpired, brokerage by brokerage, okay? It's not cloaked, all right? If you believe that, that explains why a lot of people haven't been reporting it for tax purposes. And I can tell you this, if you've got significant amounts of cryptocurrency gains that you haven't reported for multiple years, you have criminal tax exposure if you're ever audited or criminally investigated. How do I fix that? There's a government program called the Voluntary Disclosure, in which case I approach the federal government on your behalf and I say, I have a taxpayer that wants to get right over unreported cryptocurrency. In exchange for a pass-on criminal prosecution, they're going to tell you all about activity involving their tax returns that very easily could pass as tax fraud, okay? If you haven't been reporting your cryptocurrency transactions and you've been doing that for multiple years and you've made lots of money doing it, that is a case that's being prosecuted daily in the United States, right? They're going after that. They're doing that by John Doe summonses. You've heard of the one against Bitcoin themselves. They also went against Kraken and several others where they're getting your trading history directly from the brokerages. It's just a matter of time before they come knocking on your door if that's you, okay? All right, so let's get into it. I can get you a pass-on criminal prosecution and get you back into compliance as long as you're willing to knock on the government's door before they knock on your door. All right, so cryptocurrency supposedly was created back in 2009 by a group using the alias of Satoshi Nakamoto. The U.S. Treasury identifies Bitcoin as a decentralized virtual currency. The stuff can be transferred without a central bank, which saves on transaction fees. Transaction fees can be as little as 1%. There's no central authority for cryptocurrency, which gives everybody the ability to trade at will and choose with whom they associate with, interact, or exchange. This has created a money laundering concern. Matter of fact, it's known that the Sinaloa cartel, for example, used to have trucks come across the border full of cash, and the only way they could tell how much cash was in those trucks was to weigh them and guesstimate it because it was too much effort to actually count it. Now, the money is being laundered through cryptocurrency, and it's known that a flash drive is going across the border, and that can be very easily hidden somewhere on the body. And therefore, there's a stink coming off cryptocurrency. Right? A lot of the uses of cryptocurrency in the beginning were nefarious, where on the black web you could hire a hitman, you could hire a prostitute, you could buy drugs. And the original use of cryptocurrency was to supposedly have a non-traceable way to pay for these things. So the very funds you used to buy something nefarious couldn't trace back to you. So, I mean, the authorities have kind of a dim view in a way of cryptocurrency. And to tell you the truth, I consider it the wild, wild west of taxation. The IRS has not done a good job of laying out how this stuff should be taxed. There's a lot of transactions involved in cryptocurrency where there's not a whole lot of guidance, and there's a whole bunch of disinformation out there about how to treat cryptocurrency transactions for tax purposes. If you become my client, we take positions that are defensible, okay? And if there's a gray area, we disclose to the government that we are in a gray area, that we're not exactly clear what the law is, but here's what we think is fair to the government and fair to our client. Transactions in cryptocurrency are conducted via a public ledger, and it's verified using network nodes by what are called miners. What miners do is they solve very, very complex mathematical formulas that require huge amounts of computing power to verify that this transaction in the blockchain ledger is valid, that you have a valid transaction between a buyer and a seller. And it basically involves looking at every cryptocurrency transaction back to the dawn of time that has led to this one. All right, so as time goes on, those calculations get harder and harder and harder. There are lots of competitors of Bitcoin. Examples are Litecoin, Dogecoin, Purecoin, Quark, NXT, and others. Most cryptocurrency involves using a digital wallet. What a digital wallet is there is a key that unlocks the cryptocurrency. The cryptocurrency is out on the public ledger. The key that allows you to access that coin is personalized, and it's kept in an electronic wallet. That can be reduced to a flash drive, it can be a computer, but there's a whole bunch of complexity that lacks beneath the surface here, especially involving cryptocurrency wallet interfaces. We'll get into it. Most cryptocurrencies use a similar model to Bitcoin. Bitcoin is engineered to appreciate in value over time due to an artificial scarcity that's actually designed right into its model. To create scarcity, they place a limit on how many coins will ultimately be minted. Right now it's set at 21 million. Users can mine for Bitcoins, which is the methodology that injects new coins into the system. What is actually occurring with mining is that users are contributing computing power to actually make the whole system go, as earlier discussed. For their work performed in keeping the Bitcoin model working, miners are rewarded in cryptocurrency. Miners that are paid in cryptocurrency are taxed at ordinary income rates that are subject to self-employment taxes. Self-employment taxes are very expensive. In California, between California and federal taxes, it's 15.2% in total before you even begin to pay income taxes. At ordinary income rates, there's a difference between preferential capital gains rates, which are lower, and ordinary income rates, which ramp up as you report more income on your return. The highest individual rate for federal purposes is currently 37%. Okay, here's a basic premise. Individuals and businesses that accept cryptocurrency in exchange for services must pay income tax on that income. They must report the cryptocurrency transactions or face income tax evasion charges. Any individual that is involved with cryptocurrency must keep fastidious records. Otherwise, reporting for tax purposes is going to be tough. When someone comes to us to report their cryptocurrency transactions, the first thing we have to verify is whether they properly reported cryptocurrency in prior years. This is why it's more expensive to take on a new client in cryptocurrency. We cannot get your basis correct in the current year for your cryptocurrency unless we look at your complete history of cryptocurrency transactions into the current year. How do we do this? We ask you to go out to every brokerage you've ever done business with, download an ASCII2 download file. We upload that file from each brokerage you've done business with into special software that'll tell us year by year what you should have reported. We might be in a position where we have to amend prior year returns in order to get the reporting correct in the current tax year. What's even more frustrating about this is that there's about 35 services out there that will calculate your gains or loss in cryptocurrency. Every single one of them will give you a different number. What we try to do here is use the same cryptocurrency taxation calculation service that the IRS uses where possible. Unfortunately, That service just basically came out and said they're no longer servicing any other client than the IRS. Beyond frustrating. So if you don't keep good records with your cryptocurrency, which is a challenge to begin with, what we've seen happen time and time again is brokerages go under, they go bankrupt. Brokerages get hacked, your cryptocurrency disappears. You lose a wallet, you lose access to a wallet. There's all these problems with keeping decent records of cryptocurrency. And what you really need to be able to show is the original cash that went into cryptocurrency, any exchanges from one cryptocurrency to the next, anytime you utilize cryptocurrency, sold it, anytime you got paid in cryptocurrency, anytime you sold goods for cryptocurrency. All of these transactions have different ramifications. What we've seen happen in audits and criminal investigations involving cryptocurrency is if you don't have that very specific trail of every transaction leading to the next transaction, what the government's going to do is if a new cryptocurrency pops up out of thin air, in their opinion, in other words, they can't see where it came from, they're going to treat it as income. They're going to treat it as if someone gave you cryptocurrency. Now, that gets even screwier because if they assume they gave you cryptocurrency for rendering services, they're going to tax you in that manner. If they assume you sold goods, they're going to tax you in another manner. If they assume you were mining, they're going to tax you in a third manner. It becomes very messy, and the bottom line is it's inherently difficult to keep decent records in cryptocurrency to begin with because of the nature of the stuff. Let's get into the tax implications and reporting requirements surrounding cryptocurrency. There are some differences in treating cryptocurrency over any other type of security. Matter of fact, there's even arguments whether cryptocurrency is a security or not. I can tell you this, that the Securities and Exchange Commission is looking more and more into cryptocurrency brokerages. For a while there, I had high school seniors calling me up wanting to open up a coin brokerage out of their garage. It was the wild, wild west. It is starting to get legitimized, but I would still be very, very careful as a cryptocurrency investor where you put your money. Okay, so the tax implications surrounding cryptocurrency are rather unique. To start with, the WASP sale rules that apply to a lot of types of securities that basically say if you sell a security, ordinarily at a loss, this is why you do this, it's called loss harvesting. You sell a security at a loss, you throw off that loss, then you turn around and buy that security again, you've just freed up a loss, and you're right back in the same position. Well, that's called a wash sale, and that's prohibited in most types of securities. Right now it's rumbling around Congress, they're trying to do the same thing with cryptocurrency, but as of yet they haven't. So the wash sale rules don't apply. Okay, the IRS has come out and given some information about the basis rules that surround cryptocurrency. You have the option of using first in, first out. Matter of fact, most software packages that you could go out and use to calculate the gain or losses on cryptocurrency prefer the first in, first out method. Unfortunately, if you switch from one type of software to another, it may be necessary to do a change in accounting method if you were using LIFO, for example, last in, first out, and that software doesn't allow you to keep it on LIFO, it forces you into FIFO. In that case, we have to do a change in accounting method, go back and figure out your gains and losses in prior years had you been using FIFO all along, and pick up those changes on a change in accounting method form. Sometimes that's necessary. You can use first in, first out. The first cryptocurrency that came in is the first one you sell if there's a sale down the road. Last in, first out. The last cryptocurrency you bought, if you turn around and sell a cryptocurrency, it was the last one you bought that you just sold. Then there's called the selective cost basis. You have a bunch of securities that you acquired at all sorts of different fair market values, and you can go in and selectively pick whether it was a cryptocurrency you paid a lot for currently or something you paid a little bit for a long time ago. In a rising market where cryptocurrency is becoming more and more valuable as time passes, the last in, first out method will ordinarily produce the lowest tax liability, while FIFO will do the same in a falling market. In other words, where prices are falling. You want to be using first in and first out. Taxpayers that are paid in cryptocurrency for rendering services, That income is taxed at ordinary income rates subject to self-employment taxes. Businesses that are making payments for products, services, for whatever, in cryptocurrency have the same reporting requirements as if they were using cash. Ordinarily, once you have paid $600 to one source, you're required to 1099 that source. So where is the most current IRS guidance on cryptocurrency taxation found? Well, they've been doing it by what are called Internal Revenue Notices. First, there was 2014-21. The basics of that was treat cryptocurrency as if it's property, and you get a lot of your rules stemming back to that. Okay. Then there was Revenue Ruling 2019-24, IRS Notice 23-34, IRS Revenue Ruling 2023-14 is the most current guidance. Okay, in Revenue Bulletin 2014-21, the IRS defined cryptocurrency as a virtual currency. All right, it's not currency per se, it's virtual currency. There's a difference. They know it can be used to acquire goods and services. It can be held for investment. They define virtual currency as a digital representation of value that's used as a medium of exchange or to store value and has some functions like real currency. While it functions like legal tender, the IRS says it does not enjoy the legal status of legal tender in any jurisdiction, the US or otherwise. Bitcoin, for example, is a convertible virtual currency, meaning that at all times it has an equivalent value in real US dollars, in real currency. It functions as a substitute for real currency and can be digitally exchanged between buyers and sellers. It can be purchased via or exchanged into US dollars and many other foreign currencies. Cryptocurrency is virtual currency, but it's not really treated as currency per se, except that it's kind of interesting that right now in El Salvador, they're using cryptocurrency as a medium of exchange, as a currency, mainly because inflation is out of control there. The good news here is that the government doesn't treat cryptocurrency as foreign currency per se. Therefore, there's no foreign currency gain or loss in exchanging in or out of it. A taxpayer who's paid in virtual currency for goods or services, the way you value that good or service is by looking at the fair market value of the virtual currency that was exchanged, converted into US dollars as of the date of payment or receipt. As far as valuing cryptocurrency goes, how the US government does it is they have 9 different listing services that they look at that list the value of cryptocurrency at any one point of time. They take those 9 different services, they come up with an average value by adding up all 9 brokerages and divided by 9, and that's what they use. Almost any other method, though, as long as it's consistently applied, is acceptable. The fair market value of cryptocurrency basically is calculated by converting the cryptocurrency into US dollars, using the applicable exchange rate that's then in effect. The exchange rate that you use is okay as long as it's used in a reasonable and consistent manner. You don't have to do what the government did and choose 9 different services and average it. You can use one, but you always better use the same one. Every time that you spend cryptocurrency, you could have a gain or loss on the transaction. For example, if you bought cryptocurrency at $50 and you held it to a point where it was worth $100, and then you bought $100 worth of property, well, you have a $50 capital gain just from the cryptocurrency in that transaction. It can work the other way around. Let's say you buy a Bitcoin for $100. You spend it at a time when it's only worth $50. In that case, you have a capital loss when you spend that coin of $50. Said another way, a capital loss occurs where the fair market value of the property received is less than the adjusted basis you have in the virtual currency that you spent on it. The character of the gain or loss generally turns on whether the virtual currency is a capital asset in the hands of the individual taxpayer that's spending it. A taxpayer must recognize ordinary gain or loss on the exchange of virtual currency that is not a capital asset in their hands. When would cryptocurrency not be a capital asset? One of the ways that I've heard a lot of people want to go about saving taxes is to form an entity to basically house their cryptocurrency trading activity. If you trade in cryptocurrency, you're a day trader. My problem with doing that is inventory inside a corporate entity could potentially be viewed as inventory of a business by the IRS, in which case every time you spent a cryptocurrency, it would be ordinary gain or loss rather than capital gains, potentially. I touched upon being a day trader in cryptocurrency. There's a continuum of activity between just parking some money in cryptocurrency and then watching what happens with it, which would be viewed on a continuum as investing activity, passive activity, because there's not a lot of labor involved. That would produce capital gains or losses. On the other end of the spectrum, if you spend all day long, 8 hours a day, 7 days a week trading cryptocurrency, you could potentially be viewed as being involved with a business, a cryptocurrency trading business. Unfortunately, we've tried to take this position in audits before. We've had auditors tell us we will not view cryptocurrency trading as a trader business. They just won't do it. If you're paid in cryptocurrency as an employee, the fair market value of virtual currency that you're paid as an employee is subject to self-employment tax and federal income tax withholding and must be reported on a Form W-2. Don't let anybody tell you that they're going to treat you differently just because they pay you as an employee in cryptocurrency. Doesn't work like that. All payments made using virtual currency are subject to the identical information reporting requirements as any other payments made in any other form of property, i.e. payments by check are the same, payments by cash are the same, payments by credit cards are the same. The information reporting requirements don't change. Payments made via virtual currency from foreign payees to U.S. taxpayers are subject to the same backup withholding requirements as payments made in any other form of property. Let me explain. The U.S. government has a very difficult time taxing a foreigner that comes into the United States and makes a profit on anything. So the way they deal with that is if you're the person that's paying the foreigner, okay, for goods or services, if you're renting their real estate, if you're buying goods and services from them, you have to do backup withholding on them, okay? Backup withholding basically says you have to send 30 cents on the dollar to the United States government, and you can give them 70 cents on the dollar because there's no other way for the government to tax them, right? A lot of states have a similar requirement. California has a 7% requirement for the same circumstance. Revenue Bulletin 2014-21 mandated that any business or organization that's interacting with a substantial number of unrelated money service businesses or merchants that goes about settling payments between the various merchants and their individual customers is deemed a third-party settlement organization. This is exactly identical as if you were transacting transactions in cash. Just because your transactions in cryptocurrency does not change these reporting requirements. All third-party settlement organizations are required to report the total payments made to each individual merchant during a calendar year on a Form 1099-K. Let me tell you, this has been a nightmare in the past for a lot of my clients. The brokerages have had a hard time telling whether somebody is indeed a third-party money settlement organization or a day trader. Apparently what they did is they said if you transact a number of transactions exceeding some number that they arbitrarily set, they sent you a 1099-K. What happened is most investors reported their transactions for the calendar year on Schedule D. Unfortunately, when the IRS matching computer comes in to check your return that you file each year against all the information supported by third parties for the year, when they get a 1099-K, they're looking for income to a Schedule C business. The computer comes along and says, you didn't report this income from sales from a business. That's what we're expecting to see if you get a 1099-K. Even though you may have dutifully reported or accurately reported all your cryptocurrency, what's happening is the IRS computer sends you an enormous bill for the total value of your cryptocurrency transactions for the year. That goes on a CP2000, the government sends you a bill. You hire us, we start writing letters. The government ignores our letters. Eventually they issue what's called a 90-day letter, in which case you have 90 days to file a tax court petition or the bill they sent you becomes due and collectible, all right, and they can begin collection action after that 90 days. Well, once we file a tax court petition, that gets us in front of an appeals officer. We have never had a problem resolving this issue, but it's caused a whole bunch of problems for our clients. Well, the IRS, in their infinite wisdom to try and fix this problem, has come in and said, well, brokerages, you're not going to issue a 1099-K anymore. We want you to issue a 1099-DA, DA standing for digital assets. IRS computer may look for it on income as a Schedule C, may look for it on Schedule D. Now, the 1099-DA is supposed to be very, very similar to the 1099-B requirement of stocks, bonds, and brokerages of securities. In other words, they're supposed to track your basis, compare it to your sales price, and actually calculate or gain or loss. That becomes part of the 1099-DA. One of my staff has his own cryptocurrency investments, and he prepares these tax returns all day long. And he's told me what he expects to happen is that just like the security brokerages have a hard time tracing basis when they get assets transferred in from other brokerages, the individual coin brokerages are going to lose your basis if you move cryptocurrency from one brokerage to another. In other words, those 1099-DAs are probably not going to be accurate, which is going to cause the host of new problems. Typical IRS, fix one problem by creating another problem. Well, it's a good thing they are the way they are. I make my living fixing those problems. If you underpay your taxes, underpayments related to virtual currency transactions are subject to accuracy-related penalties just like any other understatement of tax on a tax return. If you're a brokerage and you're faced with 1099-K reporting requirements or 1099-DA reporting requirements and you screw them up, if they're not accurate, you can be subject to the information reporting penalties found under sections 6721 and 6722. Also, I must warn you, if you're conducting transactions directly with the public, all right, you're bypassing a brokerage. You're buying and selling with individual parties, not through a brokerage. The government can come in and label you a money service business. If you're not licensed as a money service business, that can be civilly or criminally prosecuted. You would also have all the same reporting obligations of a bank. You would have suspicious activity reporting obligations. You would have know your customer reporting obligations. You would have anti-money laundering regulations. It goes on and on and on. If you don't want to be treated as a bank and spanked for not complying with the regulations banks are faced with, don't trade with the public directly. Revenue Ruling 2019-24 came along and said, if a taxpayer receives cryptocurrency via airdrop or hard fork, that may be a taxable event. Well, let's first look at hard forks. There were two different varieties. What a hard fork is for some reason the cryptocurrency ledger splits. It splits from one ledger into two. Okay? Sometimes this is done purposefully, and sometimes this happens by accident. If it splits into two ledgers, and one of the ledgers is completely ignored, there's no tax ramifications from that. Okay? You're still on the first ledger, and you really haven't had an accession to wealth. But if there's a hard fork and you do receive immediate value for the cryptocurrency on the second ledger, you have a taxable event. How would you know? Well, new coins must be distributed to you. So you have your old coins and your new coins. That's a clue you've had a taxable event. You also must be able to exercise dominion and control over that new cryptocurrency. An airdrop, on the other hand, is like a bonus for being invested in one particular cryptocurrency blockchain. Like you own Bitcoin. As a bonus for owning Bitcoin, for every one coin you own, they can come along and send you 5 additional coins at random. Those 5 coins, if they have value, are taxable to you as received. This isn't necessarily fair in the event of airdrops. For example, with Bitcoin, you had the traditional Bitcoin blockchain, and then a new one came along called Bitcoin Gold. They airdropped you the Bitcoin Gold coins. The government said the fair market value of those gold coins is set in stone at the fair market value you receive them. But it's really interesting to note that the value of the traditional cryptocurrency took a dive temporarily as a result of that split. The government did not give you credit for that loss in value or offset it against the fair market value of that airdrop. Said another way, a hard fork occurs when a cryptocurrency ledger undergoes a protocol change. This results in a permanent division in the blockchain. Instead of one blockchain, you have two blockchains, both of which may have value. A hard fork may result in the creation of a new coin and a legacy coin. Following the hard fork, transactions involving the new cryptocurrency are recorded on the new ledger. A prime example of this occurred in 2017 when Bitcoin Cash broke off from Bitcoin. An airdrop is an electronic means of distributing units of cryptocurrency to the distributed ledger address of multiple taxpayers unilaterally and simultaneously. When an airdrop occurs alongside of a hard fork, a distribution of coins is sent electronically to the address of all of the legacy cryptocurrency holders. Legacy meaning the original cryptocurrency before the hard fork. For example, when the Bitcoin to Bitcoin Cash hard fork occurred in 2017, Bitcoin holders received electronically an equivalent amount of Bitcoin Cash to their original Bitcoin holdings. Cryptocurrency from an airdrop that is received electronically is valued at the date and time that is recorded to the distributed ledger. If a taxpayer is not able to exercise dominion and control over the cryptocurrency they receive by airdrop, then it is not considered a taxable event until they do have that control. Under Code 61, all gains that are undeniable accessions to wealth that are clearly realized, over which a taxpayer has dominion and control, are included in gross income in the year in which that occurs. In general, all income is ordinary unless it is gained from the sale or exchange of a capital asset, or a special rule applies converting it to capital gain or loss. With airdrops, even though the cryptocurrency may be a capital asset in your hands, the income from the new accession of wealth is treated as ordinary. You do not get the benefit of the lower capital gains rates. When a cryptocurrency coin is received by airdrop or hard fork, even though it's not been purchased, the basis of that coin when you go to sell it later on or exchange it later on is the fair market value of the property at the time it was originally received. Under Code Section 451 of the Code, taxpayers on the cash method of accounting are to include a transaction in taxable income in the year in which it occurs. It occurs in the year that funds or value is actually or constructively received. Under the accrual method of accounting, generally you're to include in the amount of income in the tax year in which all events have occurred that give you a right to receive value. Now we're moving into IRS Notice 2023-27. 2023-27 goes into NFTs. NFT stands for non-fungible tokens. NFTs are a unique digital identifier that is recorded to a distributed ledger. It uses the same technology that Bitcoin does, for example. It may be used to certify the authenticity and ownership of an associated right or asset. An NFT can signify ownership of a digital image, digital music, digital trading card, or a digital sports moment. An NFT can also certify you have the right to attend an event, like a ticket, or certify ownership of a physical item. NFTs bring even more complexity to your tax life. Under the Internal Revenue Code, there are different capital gains rates where you're investing in what are called collectibles. Art, for example, is a collectible. Well, the IRS tends to look at NFTs and ask the question, is the underlying asset a collectible? If it is, they use something called a look-through analysis to change the tax ramifications of it. You no longer get the preferential capital gains rates, you get shoved into a collectible rate. The collectible rate is 28%, where if you're using the standard capital gains rates, it could be 0, 5%, 10%, 15%, or 20%, depending on the amount of adjusted gross income you have on that return. With NFTs, you go straight to 28%. Using this look-through analysis, they look to see whether the underlying asset constitutes a Code Section 408M collectible asset as defined under that code section. While Revenue Ruling 2023-27 mandates this collectible treatment, we have not seen the IRS actually applying this yet. It's something they keep talking about doing, but not necessarily enforcing. For example, a gem under Code Section 408M, precious gem, is considered a collectible. Therefore, if you had an NFT that signified ownership of a precious gem, that NFT itself would be considered a collectible. By opposite logic, if an NFT signifies ownership of something that is not a collectible, the NFT itself is not a collectible. For example, Facebook wants to develop an NFT that represents a plot of land in a virtual environment. In their virtual environment, you can come in and live your whole life in a virtual reality environment, and you can pay cryptocurrency to acquire land in a virtual environment. Well, that land is not a collectible, therefore the NFT would not be treated as collectible. Internal Revenue Code Section 408M2 defines collectibles as the following: works of art, rugs and antiques, metals or gems, stamps or coins, even alcoholic beverages, or any other transaction that the Secretary comes along and calls a collectible. Where an asset is classified as a Code Section 408M collectible, this is also relevant for other sections of the Internal Revenue Code. For example, the sale or exchange of a collectible, that is a capital asset that's held for longer than 1 year, a collectible, is subject to a 28% capital gains rate rather than the other preferential capital gains rates of 0, 5, 10, 15, or 20, depending on the type of the asset. It jumps straight up to 28% if the asset is classified as a collectible. Under IRS Revenue Ruling 2023-14, staking rewards are taxable in the year in which you gain dominion and control over the staking reward, and the fair market value is determined at the time frame in which you gain that control. Should you report your cryptocurrency transactions on an 8949 or on Schedule D? As a starting point for this discussion, it is essential to note that many of the reports prepared and made available by popular cryptocurrency brokerages like Bitcoin, etc., they may be insufficient for tax purposes. The problem is caused by the fact that many cryptocurrency traders use a variety of coin brokerages and wallets and exchanges. Where a taxpayer uses a variety of virtual services, wallets, coin brokerages, etc., no single wallet or exchange can determine what occurred prior to importing your cryptocurrency into that wallet or exchange. Neither can it determine what happens after it's been exported out of that cryptocurrency brokerage or exchange. Your goal in reporting cryptocurrency taxable transactions is to determine if all the gain or loss on all of the individual transactions is accurately computed. To tell you the truth, when we pick up a new client, the only way we know if their basis is correct in the year we start reporting for them is to look at their history of cryptocurrency transactions from the dawn of time forward. We can't get basis correct if all of the transactions haven't been reported correctly in prior periods. And to make this even more complicated is that there are a variety of tools that cryptocurrency traders can use to determine their taxable results. All of them function the same. Basically, you go back to every coin brokerage you've done business with, every wallet you've held cryptocurrency transactions in, and you download the activity in that brokerage and those wallets. Okay, ASCII2 download files. Then you import them into a transaction software that determines your gain or loss. Well, every single one of these programs gives you a different result. Matter of fact, the IRS, we can't even use the same software as them anymore because that software program has been dedicated solely to large institutions. Individual investors don't have access to it anymore. Go figure. The bottom line is once you figure out what the proper transactions are, you report them on Form 8949 and you report each taxable transaction. Is it a taxable transaction if you take something in a digital wallet in an account or something at an address and transfer it to another digital wallet, an account, or address? Generally, the answer to that is no, but keep this in mind. If you're undergoing an IRS audit, or God forbid, a criminal tax investigation, and that auditor is looking at a wallet, account, or address and sees a cryptocurrency just pop up in it, and you can't prove the historical movements of that cryptocurrency, where you bought it, what wallet was in, what exchange it was on, what they're going to do is treat that as if it were a deposit of cash in a cash account. In an audit, any deposit of cash is income unless you can prove it's not. They're going to do the same thing to you with cryptocurrency. If you can't prove where it came from, and this is really a problem if you've had an exchange that's gone down, or you can't get records to an exchange anymore, but yet you have cryptocurrency that came out of that exchange. It becomes a problem in an audit. Okay, they're going to look at it and say it's taxable income, it's ordinary income, as if you rendered services and you got paid for that in cryptocurrency. And it's going to be taxed to you at its fair market value on the date of transfer with zero basis. If you own several blocks of a specific type of cryptocurrency, for example, you bought Bitcoin over 10 different dates in 10 different block amounts using 10 different purchase amounts, can you choose which one of those blocks you're selling? It's advantageous to choose a block of cryptocurrency that you paid more for than a block of cryptocurrency you paid less for, because you reduce your capital gains by doing so. Yes, that's called the specific identification method, and if you have good enough information to specifically choose which block of cryptocurrency you're selling, that's an acceptable method called the specific identification method. How do you go about identifying a specific block or unit of virtual currency? You can go about this by looking at a specific unit of virtual currency by documenting either the specific unit's unique digital identifier, such as a private key, a public key, and or an address. Or you can do this by showing the transaction information for all units of a specific virtual currency, such as Bitcoin, held in a single account, wallet, or address. This information must show, first, the date and time each unit was acquired. 2, your basis and the fair market value of each unit at the time it was acquired. 3, the date and time each unit was sold, exchanged, or otherwise disposed of. And 4, the fair market value of each unit when it was sold, exchanged, or disposed of, and the amount of money or the value of property received for it in exchange. If you do not use the specific identification method, you are forced to use the FIFO method. That is the first in, first out method of valuation of cryptocurrency. Meaning when you start selling cryptocurrency, you're deemed to have sold the first cryptocurrency you acquired. The earlier cryptocurrency is the first one sold. What are the tax ramifications of cryptocurrency that's received as a gift? Well, first of all, there's no income to be recognized when you receive a gift of cryptocurrency until that cryptocurrency is sold, exchanged, or disposed of. Your basis in cryptocurrency that's gifted to you is the same as the donor's plus any gift tax he may have paid for the transfer. If the donor is unable to provide you accurate basis information on the cryptocurrency they give to you, your basis in that cryptocurrency is zero. You will be treated as having the same date of acquisition as the donor on cryptocurrency. The date they acquired it is you're treated as having that same date of acquisition. Again, if they can't provide you this information, your date of acquisition is the date you received gift of the cryptocurrency. If the person gifting you cryptocurrency happens to be a non-resident alien, a couple things to remember here. First of all, if the gift of cryptocurrency exceeds $100,000 for a calendar year, you must file Form 3520 to report the gift, or you will face penalties up to 35% of the fair market value of the gift. Another thing to remember is do not let them gift you cryptocurrency that has US CITES. Either it's in a US wallet or it's in a US exchange, because in that case, you'll face a 40% transfer tax on the fair market value of that cryptocurrency. If you donate virtual currencies to an organization described in Internal Revenue Code Section 170C, a charitable organization, you will not be required to recognize income, also gain or loss, from the donation. If you've held the cryptocurrency for at least 1 year before donating it, the fair market value of the cryptocurrency will be your charitable contribution amount. If you've held the cryptocurrency for less than a year, your charitable contribution amount will be the lesser of the following: either your basis in the cryptocurrency or its fair market value on the date of the contribution. What should you do if you all of a sudden become aware that the IRS is after your trading history and you have a long history of not reporting taxable cryptocurrency transactions? Well, first of all, I'd suggest you call me or someone like me to discuss your options. Investors in cryptocurrency who have intentionally failed to account for capital gains or other taxable transactions involving cryptocurrency, whether it be mining cryptocurrency or whether it being paid for goods and services in cryptocurrency or trading in cryptocurrency, if you've been throwing off or maybe even getting paid in cryptocurrency, bottom line, there are a lot of people out there walking around thinking that income from cryptocurrency is untraceable and therefore they don't need to report it for tax purposes because the government will never know you have it. Well, I tell you what, if they're after your trading history and you've been doing this, you have criminal tax exposure, and I wouldn't go back and just amend returns. If you amend returns and you show a whole bunch of taxable income for prior years that you didn't report related to cryptocurrency, that could be deemed a criminal admission. Come talk to me. I have a way of getting you back into compliance without the risk of facing criminal tax prosecution. If you've engaged in a scheme to avoid or evade cryptocurrency taxation, penalties go beyond civil, okay? On top of a civil fraud penalty of 75% on the dollar for any tax they assess, you could also be looking at a state or federal prison sentence. Federal courts have been routinely granting the IRS what are called John Doe summonses. The IRS has successfully used John Doe summonses to obtain millions of traders' information off of different brokerages already. For example, everybody's heard about the John Doe summonses against Coinbase, Kraken, and others. The IRS has been using John Doe summonses to go after offshore tax non-compliance in a big way. People illegally using offshore credit cards, foreign accounts, and offshore entities to commit offshore income tax evasion. They're using the same approaches to go after people not reporting cryptocurrency. The bottom line is that the IRS is very adept at using John Doe summonses as the first step in discovering an account holder's real-world identity. The IRS has successfully used John Doe summonses to obtain cryptocurrency trading information from the following brokerages. Coinbase was summoned successfully in 2016, and after a court battle, the summons was enforced in 2018. Kraken was summoned in 2021, Poloniex was summoned in 2021, and SFOX was summoned in 2022. Cryptocurrency traders are required to report the taxable events every time they make a purchase with cryptocurrency, sold cryptocurrency for money, exchanged them for value, or even mined them. Because of recent known and even unknown John Doe summonses, cryptocurrency traders with non-reported taxable transactions are at risk of criminal tax prosecution. Non-compliant traders can face both civil and criminal enforcement action. There's also exposure for accuracy-related penalties and information reporting penalties. Penalty relief may be available for taxpayers and other persons required to file information returns who can establish reasonable cause for not doing so. Tax preparers that are aware their clients have taxable cryptocurrency transactions but counsel against reporting this taxable activity are at risk of several different types of tax crimes themselves. If you have mined, traded, or engaged in other forms of taxable cryptocurrency transactions, and have a history over multiple tax years of not reporting this type of activity. It is essential that steps are immediately taken to mitigate the potential civil and criminal exposure for this non-compliance. As alluded before, this may include amending past tax returns if the tax dollars are small, filing missed tax returns if you just didn't file, or worst case scenario, making what's called a voluntary disclosure. And voluntary disclosure virtually eliminates the risk of criminal tax prosecution if the terms of the program are met and followed. As previously alluded to, the IRS has already taken steps to identify taxpayers who are utilizing cryptocurrency to achieve income tax evasion. As the IRS continues to gather information from a variety of domestic and international tax institutions, we are seeing ever increased efforts to gather information from both domestic and international financial institutions regarding unreported cryptocurrency transactions. We are seeing the IRS get more and more aggressive with its civil and criminal tax enforcement efforts surrounding cryptocurrency non-compliance. If you have a history, a multiple-year history involving large dollar amounts of unreported cryptocurrency income, you should consider making a voluntary disclosure. It is the only guaranteed method to come back into compliance in that scenario without facing criminal tax prosecution. Again, the primary purpose of making a voluntary disclosure is to take intentional non-compliance or tax evasion, fix it, get you back into compliance without facing criminal tax prosecution. The program is literally strong enough that you can say, I didn't think you could see my cryptocurrency transactions, therefore I didn't tell you about them because frankly I didn't want to pay tax on them. You could literally admit to that, which is criminal activity, and receive a pass on criminal prosecution. It's kind of interesting, if you murdered somebody, there's no government program to bring that body back to life and give you an nomine patria, I forgive you of your sins. But with tax evasion, we're talking completed crimes, you can receive a pass on criminal prosecution if you comply with the program terms. Also, the program is private, nobody else finds out about it. Please, 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 if you're going to consider a voluntary disclosure, make sure you talk to someone like me, a criminal tax defense attorney. Don't let a CPA, an EA, or anybody else that's not an attorney talk to you about what is essentially the practice of law. Very important. An attorney needs to be consulted for the following reasons. First of all, an attorney needs to determine if you're even eligible to make voluntary disclosure. Eligibility concerns a lot of things. One primary thing is the actual source of the income we're talking about legal source income? If not, you can't use the program. So, if you're a hitman and you didn't report your hitman income, can't use this program. If you're a drug dealer and didn't report your drug dealing income, you can't use this program. It has to be legal source income. The attorney needs to approach the IRS Criminal Investigation Division and do a pre-check to determine if you're even qualified to enter the program. What that basically means is the IRS already criminally investigating you? If so, you don't qualify for the program. And guess what? If you're denied entry into the voluntary disclosure program, that usually means you're already under criminal tax investigation. To tell you the truth, I've had a couple of those in my career history, and we complied with the terms of the voluntary disclosure anyways, knowing full well the client was under active criminal investigation, and we were able to convert what is essentially a criminal tax issue into a civil tax issue. Clients didn't go to jail. Once we have an indication that a client has been accepted via a pre-check, the voluntary disclosure can begin. If you find yourself under audit and you have multiple years of unreported cryptocurrency transactions in your history, please contact us. You're facing what we call in the industry an eggshell audit, or maybe even a reverse eggshell audit, and therefore you have criminal tax exposure over that unreported cryptocurrency. This firm specializes in those types of audit, and I'd like to say to date we've never had an audit client go to jail, even where they have had a history of criminal tax noncompliance. If you're under audit, the IRS takes two approaches involving cryptocurrency, usually depending upon the sophistication of the auditor. Auditors always want to see the underlying raw data of your cryptocurrency transactions, ASCII2 download files from brokerages, all of them, over the entire history of your cryptocurrency trading. If you're not able to provide this transaction history, the first negative ramification is the basis in your cryptocurrency trading history will be assumed to be zero. The IRS will take this raw data, this ASCII2 download files, and they'll upload it into their own proprietary software. One of the approaches we've seen them use is where they can't exactly follow a transfer between multiple brokerages, multiple wallets, multiple addresses. Sometimes they'll take basically an income or expense approach where a transfer in is treated as income, a transfer out is treated as an expense. Our approach in representing a client in a cryptocurrency audit is to go back to the dawn of time, reconstruct their trading history to the best of our ability, look at reporting in prior years, determine what basis was at the beginning of the current tax year, provide our calculations to the auditor, and then defend them if challenged. Well, again, if an auditor is not satisfied with basis, they're going to treat it as zero. Okay? Where data is missing, we've been successful in supporting transactions in the following methods: by showing an email verification of a transfer, by using a third-party blockchain scanner to show transfers into and out of a wallet that establishes a consistent pattern. The problem with that approach is it can backfire because most exchanges use a general wallet ID for crypto received and not a specific ID for each account. Therefore, an auditor could potentially take all transactions in a general exchange ID as belonging to the taxpayer. It's important to note that this method can backfire since most exchanges use a general wallet ID for crypto received and not a specific ID for each account. This means the auditor could potentially take all transactions in a general ID as belonging to the taxpayer. The proprietary software that the IRS uses to determine taxable results from cryptocurrency exchanging or transactions determines fair market value of each transaction using a compilation from sites such as CoinGecko, and then comes up with an average value. Since exchange timestamps can vary from exchange to exchange, the IRS program looks for matching transactions in a 12-hour time range each direction. The accounting method routinely used in IRS audits of cryptocurrency is FIFO. When might you have a FACTA or FBAR reporting for cryptocurrency? In other words, some sort of an offshore reporting requirement for cryptocurrency. Well, the problem with cryptocurrency is that a user could print out their full or partial trading history and carry it around like cash in their wallet or purse. The actual information to exchange a cryptocurrency can be carried around in paper. A user can also download all this information into a digital account known as a crypto wallet. These distinctions are technically important because other items have been identified as foreign accounts that are of a similar nature and require offshore reporting. For example, hard currency, precious metals held directly, personal property, and certain covered benefits are not reportable for FBAR or FACTA purposes. Users of cryptocurrency can place the value of cryptocurrency in accounts held offshore, or they can store the information electronically that represents the value in their cryptocurrency offshore, or they can trade cryptocurrency through a foreign exchange. These transactions would seem to raise concern about FACTA and FBAR reporting for cryptocurrency. To date, FinCEN, the organization responsible for FBAR and FACTA reporting regulation, has seemingly excluded cryptocurrency from the definition of a reportable foreign account. For the 2014 tax filing season, Rod Lundquist, a senior program analyst for the Small Business Self-Employed Division, He elaborated that FinCEN had said that virtual currency was not required to be reported on an FBAR, at least for the 2014 filing season. Despite the unofficial nature of this guidance, it's still the only statement on record where the IRS has gone on record about cryptocurrency reporting and the FBAR. It's also important to remember that was regarding one filing season. When we look at recent enforcement actions of the IRS, this may suggest the IRS is reconsidering this approach regarding cryptocurrency and foreign account information reporting. It's important to remember, in a situation where there are no penalties for disclosing something that's not required to be disclosed versus getting penalized for not reporting something that is required to be disclosed, when in doubt, disclose. At the present time, it's impossible to know whether cryptocurrency will eventually be required to be reported on an FBAR. It also is impossible to tell you whether it'll just be required on a go-forward basis or whether they're going to require retroactive reporting back to the dawn of time. We think it's reasonable for taxpayers to align their handling of reporting of cryptocurrency to comport with that of gold or hard currency. That is, these assets are not reportable for FBAR purposes when held by a taxpayer directly, but become reportable when stored in a foreign financial account. Under this approach, a taxpayer who carries around only printed records of cryptocurrency transactions, they would not report this cryptocurrency for purposes of the FBAR or FACTA, even if this is occurring offshore. On the other hand, a taxpayer who has placed his or her cryptocurrency in a virtual wallet hosted offshore should consider including cryptocurrency for purposes of FBAR aggregation to reach the $10,000, FBAR reporting, and FACTA, the 8938. We believe this approach would provide a taxpayer with at least a reasonable basis for an unsettled issue. Cryptocurrency reporting is basically the wild, wild west of taxation. In my opinion, the IRS has done a poor job of clarifying a bunch of unsettled issues regarding cryptocurrency transactions. For example, to date, there's no official valuation method or source regarding cryptocurrency and other virtual currencies. Instead, multiple various websites across the internet update exchange rates for cryptocurrency throughout the day. A simple Google search will verify that all of these cryptocurrency valuation services will reach a different valuation conclusion. Because of this, it's extremely difficult for a taxpayer to accurately measure the value of their cryptocurrency at any given time. Furthermore, taxpayers have not received guidance from the IRS as to whether averaging valuations from different valuation services for cryptocurrency is an appropriate valuation methodology. Well, I'd like to thank you very much if you've sat through this whole cryptocurrency taxation video. I'm sure it's in excess of an hour. There's a lot here. Cryptocurrency is the wild, wild west of taxation. We do the best we can with it. We believe we take positions that are reasonable to our clients and reasonable to the government. We just hope the government understands if there's a difference of opinion about how cryptocurrency should have been reported, that we are indeed trying to be fair. Anyways, look forward to talking to you about your cryptocurrency issues. Dave Clausing, tax attorney, CPA.